For a long time now, the enterprise software cohort has just been a house of pain because Wall Street's terrified they're going to be steamrolled by generative AI platforms that are very good at writing code. But we really haven't seen all that much impact in the actual numbers for these companies. Instead, the enterprise stocks, they've been pummeled by multiple compression. Just take a look at ServiceNow. Here's a stock that peaked exactly 1 year ago. It's now down over 45% since then.
Today we are talking all ServiceNow, the main AI risks, stock-based compensation, recent acquisitions, growth and estimated growth, what return we can expect if we invest in ServiceNow at $83 per share, and what free cash flow growth is implied in the current share price. If you're new here, my name is Andrew and we are talking long-term investment on this channel. Stock analysis, public portfolio and educational videos is exactly what you can find on this channel. Now the reason why I decided to dig deeper in ServiceNow is because I recorded a video where I ranked every SaaS stock to find who will survive the crash. And out of more than 20 companies ranked in that video, most of you guys was searching for ServiceNow. I saw many investors are interested in this company and I decided to dig deeper. This is the golden generational buying opportunity to buy ServiceNow, or this company has significant AI risk. And finally, the multiple will drop even lower. ServiceNow currently experiencing 65% drawdown from all-time highs, and this is the largest drawdown for this ServiceNow as a public company from 2012. How ServiceNow makes money? It has two segments. First is subscription revenue, 3.47 billion, and second segment is professional services and other revenue. The subscription revenue includes IT service management, customer service management, HR service delivery, security operations, and creator workflows. They started with just one department, IT, and then they expanded to HR, customer support, finance, and security. The growth for this company is outstanding. Revenue, exponential growth. Net income is more volatile compared to revenue, but long-term trend is up. The free cash flow is repeating the trajectory of revenue, but with lower margin. ServiceNow is making quite significant amount of acquisitions. You can see just in 2025 they closed 7 acquisitions, the largest of $7.75 billion. They bought cybersecurity startup. And most of these companies, you can see AI native, AI powered, AI native. So most of those companies they are acquiring in 2025 and even 2024 are already AI startups. So the CEO saw the AI risk in advance and he started transforming ServiceNow in advance to make sure the ServiceNow can thrive in post-AI era. Here's a segment from the interview where ServiceNow CEO is sharing the main goal of acquisitions of the company.
Jim, let me explain on these M&A moves. I proved beyond a shadow of a doubt we didn't buy growth,
right,
okay?
Absolutely.
Knock that one down. I just told you our seats are actually increasing, not decreasing. And our TAM went from 90 to 600 billion since 2019, since I've been CEO. And I just re-upped for 2030, just saying that I have enormous faith and conviction in this business. But I also did some important tuck-ins, and you say, Bill, you asked me the last time we talked, why did you do that? Because you're a builder. Well, what happened was we waited some time to get MoveWorks in as it went through the process, and now we have an agentic AI user experience, that open door where you can search, get your requests met from any data source, and have a great experience, and all the actions are taken on ServiceNow. And then we went into 2 very critical areas for the customer. One of them, which is super important, is security.
Okay.
Jim, cybercrime is forecast to cost the world $1 trillion a month. So if that was an economy, it would be third, only behind U.S. and China.
Okay.
Huge problem. So what do customers need? They need visibility and prioritization. They have to reduce their exposure before incidents happen.
Okay.
Real-time agentless discovery and classification of every asset. IT, OT, medical devices, industrial controllers, the whole 9 yards. Armis does that.
Okay.
So that's added to our great security business that's already growing 100% year over year.
As many other software as a service companies, ServiceNow is doing significant amount of stock-based compensations. Here you can see in 2017, the stock-based compensation was almost 100% of free cash flow. Fast forward to today, in 2025, we can see that stock-based compensation is less than 50% of free cash flow. So this is exactly what you want to see. But $2 billion in stock-based compensation is still significant dilution to shareholders. But another thing I have to mention is that they are doing buybacks for almost $2 billion, exactly $1.84 billion. So they covered with buyback almost all stock-based compensations. which lead us to the charts of the shares outstanding, and we can see that the dilution is becoming less and less, and in the latest quarter they diluted less than 1% of shares outstanding. And also in the latest quarter, ServiceNow board authorized additional $5 billion under share repurchase program with the primary objective of managing the impact of dilution. ServiceNow plans imminent $2 billion accelerated share repurchase. Now I will be talking about two main risks for software as a service companies and what's the reason all software sectors are being obliterated by the market right now. And later we'll be looking at the valuation and which return on investment we can get if we invest in ServiceNow today. First, ServiceNow is charging based on a seat. So let's say before you have 10 IT specialists in the company and you need to pay 10 seats for ServiceNow. But later with AI, efficiency of these IT managers improved significantly. So instead of 10, you just need 5. And also these 5 are using AI agents to do the job instead of directly contacting with the software. In this case, SaaS seat-based model cannot grow as fast as it grew in the past. Partially, ServiceNow already has solution for this problem. They already introduced usage or value-based pricing model, not seat-based pricing model. So they already started to respond to this risk. The only question from my side as investor is I'm not sure how this will affect the growth and how this will affect the margins of the company. Because if the growth is slowing down and if the margins will come down, the multiple should be lowered because the multiple for those premium SaaS was extremely high in the past. And the second AI risk is that with the tools like Claude Code from Anthropic, it's becoming significantly more simple and cheaper to build the software, to build the relatively simple software. Of course, I'm not saying here that you can rewrite the whole ServiceNow in 1 week. No, this is not what I'm saying here. What I'm saying is that ServiceNow has multiple segments. They have IT segment, they have customer support, they have HR, they have a finance, they have cybersecurity. So what I'm saying here is that some part of the ServiceNow enterprises can write in-house, and instead of using ServiceNow, they will be using those parts. So ServiceNow cannot cross-sell them with multiple segments. This is the second headwind I see for ServiceNow and other software as a service companies as well. Now, after we understand the reason of why ServiceNow stock is down 65% from all-time high, let's have a look at valuation and see if this is a generational buying opportunity or the price is still expensive and still need to come down. From the price to sales perspective, the company currently is trading at a 6.54x with a median from 2019 of 17x. What about price to free cash flow? Price to free cash flow medium was almost 60 times, and now ServiceNow is traded less than 19 times free cash flow. In the InvestKit, you can do projection to understand the return on investment for the company if you invest in the company today. So let's do exactly that. We will run a projection for ServiceNow. We will run base, bull, and bear case for ServiceNow to understand which return on investment we can expect for this company. Revenue growth. In the current financial year, they grew 21. And these are consensus revenue estimate for the next years. We can see we have 44 analysts expecting 18%, then 18%, 14%, 16%, 13%. So they are expecting revenue deceleration, but we can say that approximately 16% in average is the expectation. So let us, for the base case, we'll just put 16% for the until 2030. For the net income margin, for completely optimized for profitability ServiceNow, net income margin could be expanded from 13% to 30%. This is the expectation from the management. And for the PE, I believe when the company is growing 16% with 30% net income margin, PE of 30 is actually quite conservative. But let us go with 30. Currently, ServiceNow is traded with a PE of 50. So PE will contract to 30. If this will be the case, for the base case, we can expect ServiceNow to return 188%. Now let's run the bull case. For the bull case, we will project the revenue growth of 18% until 2030. So it's 2 percentage more than for the base case. For the net income margin, we will keep 30%. But for the price to earnings, I believe 40 is deserved for ServiceNow if the market recognizes that ServiceNow is not a loser to AI, but actually will have a headwind from AI. So the price to earnings ratio of 40 could be deserved for that. In this case, we can expect 300% upside for the next 5 years. And for the bear case, let's emulate what will happen if AI will actually disrupt ServiceNow. So now ServiceNow is growing 21%, and then we will 16%, and after 16%, it will grow 14%, and after that 12%, and after that 10%, 10%. So I think this is already extremely bearish assumptions for ServiceNow, and the margin will collapse from 30% to 20%, which means the pricing power will not be there because the LLMs and the other enterprises will just wipe code part of the ServiceNow. And PE, of course, we are growing 10% on the top line, so PE definitely not 30. For PE, we'll just assign 18. Probably 18 is the right PE for this kind of assumptions. And if we save this projection, we can see that even in this case, for the 5 years, you will not lose money, which means you will lose a little bit, but probably kind of break even, almost 0%. The market cap will be almost the same in the next 5 years, if this will be the case. Now, let me just give you a disclaimer. All these assumptions we just did with you together, it doesn't mean that the reality will be exactly like this. Feel free to come to InvestKit and apply your own assumptions, and then you will see, based on your own base, bull, and bear case, what return on investment you can expect from ServiceNow or any other company. We support any American company in the InvestKit. So feel free to come and try it out. We are doing beta tests now, and all premium features are available for free. So it seems like, based on the projection, even in the most bearish scenario, we still will not be able to lose too much money with ServiceNow. But let me show you another very useful valuation model which helps us to understand if the company is undervalued or not. This is called reverse DCF, and the reverse DCF is showing what implied free cash flow growth is priced into the company today. So currently, ServiceNow reported $4.58 billion in free cash flow in financial year of 2025. If we assume that the company is fully optimized free cash flow margins, they could be making $4.68 billion in free cash flow. And if this is the case, the company free cash flow expected to grow just of 6.24% for the next 10 years to justify the current share price. And meanwhile, with you, we just saw the Seeking Alpha analyst expecting 20% growth on a, this is not free cash flow estimation, this is the revenue growth estimation, but revenue growth is expected to be 20%, 18%, 18%, 14%, 16%, and even in 2035, we can see it's still almost 13%, very far from the 6%. So based on this case, we can say that based on the reverse DCF model, the ServiceNow could be undervalued as well. If you're a shareholder of the company and completed your due diligence, please let me know in the comments what I missed. If you found the functionality of InvestKit, including advanced projections, reverse DCF, financial analysis, the link will be in the description below. We are running beta test and all the premium features are available for free. The feedback of using InvestKit, please also let me know in the comments below. That being said, thank you so much for watching, and I will see you in the next one.